My name is Peter Walker. I'm the head of insights at Carta. And I can see in some of your faces that head of insights isn't exactly a founder title. And I get that. Maybe I don't belong on this stage. But I think the organizers of this festival asked me to be here because Carta sits on a wonderful pool of over 40,000 startup cap tables. And from those cap tables, we can aggregate and anonymize trends, insights, narratives from across the startup ecosystem. So today I'm going to walk through what we saw happen in 2023, which I commiserate with you founders. This was a very difficult year. Hopefully we have some responses from founders and investors that are happening now and into 2024. And then we'll talk a little bit about what we see as the shape of startups next year and beyond. The mission of Carta is to create more owners. And through the cap table, this system of record which shows who owns equity in these startups, we think it's a wonderful way to incentivize early employees, advisors, investors, and believers in your companies. So we're going to start with some necessary context. And again, to be clear, this isn't going to be pretty. First chart. This is fundraising from across those 40,000 companies. The black line is the total capital raised in each quarter. The bars are the total number of rounds that happen from those 40,000 startups. You can see that this takes into account globally. We are based in the US, but we have strong presences in Europe, the Middle East, and Asian startups as well. And collectively, startups on Carta raised $71 billion in Q4 of 2021, a record amount. And unfortunately, it's fallen just as quickly. In the most recent quarter, startups on Carta raised $13 billion collectively, a drop of 82%. That's not just a decline, that's whiplash. And that's whiplash that you as founders are experiencing right now. This funding dearth is the context that you need to explain all the other metrics that we're going to go through today. Now, there are certain parts of the startup ecosystem that are faring better than others. Series D and pre-IPO companies, fundraising is down 90% from peak. For your seed stage founders, you're doing relatively better, only off about 50%. But it is a difficult fundraising environment all across the fundraising stages, no matter what kind of founder you are or how mature your company happens to be. If we take a look at industries, everyone got hurt this year, but some were hurt a little bit more than others. Unfortunately, due to the name of this festival, FinTech was actually off the worst, about 75% decline. That's mostly because it had such a sharp spike in 2020 and 2021. But SaaS, consumer, health tech, biotech, medical devices, everyone was feeling pain across the fundraising ecosystem this year. And I can tell that you're sensing something missing from this slide. Peter, isn't there a silver lining? Isn't AI doing incredibly well this year? Where's AI in these numbers? Well, AI, we don't actually break out as a separate industry because you can find AI biotech, AI hardware, AI SaaS, AI finance, all across the startup ecosystem. But if we had broken it out, it is the silver lining that you would have expected. It's up about 20% year over year. And again, ChatGPT only kind of came onto the scene 9 to 12 months ago. So if we again look at stages, you can see that relatively seed stage companies across Carta garner about 7 to 10% of all capital raised in a normal year. This year it's at 12%. Whereas late stage companies get about 25% or so of the capital, and this year it's at 15. So what's happening here? You may have heard a lot of headlines about dry powder, this immense amount of capital that venture capitalists have raised across the globe that has to be deployed into companies at some point. Surely that will happen soon. Unfortunately, you can't really deploy billions and billions and billions of dollars into seed stage startups when a seed stage round is going off at $2 to $3 million US. It's just impossible to do. So you need big rounds in order to start deploying all this capital into. If we just take a look at $100 million rounds on Carta, 157 of those happened in Q4 of 21, and only 13 have happened so far this year. The missing $100 million round is something that is holding the venture ecosystem back, and I'm not sure it's going to come back until the middle or latter half of next year. So that wasn't fun. Those weren't great numbers, obviously. So how have founders responded? How have founders and VCs collectively responded to this change in fundraising? We've brought back some old terms that sort of fell out of favor in the boom times, one of which being the down round. The down round, for those of you who don't know, anytime a startup is valued at less than the prior round's valuation, that would be considered a down round. And yes, in the public markets, this happens every single day, but in the private markets, there's still a stigma attached to taking on a down round. And I want to challenge that stigma somewhat. It's a difficult moment for founders. Obviously, it's a difficult moment because they have to create a new story for themselves and their investors. And more importantly, they have to make sure that their employees remain incentivized with upside in the company, which can be erased by a down round rather rapidly. But I view this as a silver lining. This chart shows founders and investors coming to an accord and saying, look, everyone got a little overhyped in 2021. Let's take things back to reality, but not cancel out the potential of these companies. There are a lot of wonderful startups who have taken on a down round and made it through IPO and are now household names. So if you are a founder in the audience who are facing this decision, just know it's happening across the board, and you should not feel the stigma that is usually attached to it. That's a little PSA personal view there. The other thing that has been reintroduced into venture is deal structure. Terms like liquidation preferences, participating preferred stock, cumulative dividends. These are all terms that investors will add into deal terms that make it a little bit more favorable to the investor versus the founder and the employees on the eventual exit. And in 2020 and 2021, these terms basically disappeared. Everything was a hot deal with a lot of FOMO and competitiveness for investors to get into. But now these liquidation preferences and participating preferred stock, they're back on the menu. So the takeaway from this slide is that if you are a founder in the audience, I would highly recommend that you have a good lawyer who you trust on speed dial, because you're going to run into some things that perhaps your friends raising 2 years ago never saw in a term sheet. So how did startups respond to this fundraising dearth? Well, the first thing they did was they were a lot more selective about who they hired. The black line is the total number of hires across those 40,000 startups on Carta. You can see that in early 2022, January 2022, those startups collectively hired almost 70,000 employees in a single month. And lately, they've hired about 12,000 in a single month. That is, again, a huge decline. But if you look at the blue and the green lines, respectively, blue is employees choosing to leave their startup by choice, and green is unfortunate layoffs happening across these startups. You add those two lines together, and you get that orange dotted total departures. And you can see that the orange line in recent months has come in above the black line, meaning that as an industry, as an asset class, startups have declined. They have shrunk in terms of the total number of employees. That's the first time that we've seen that happen since 2013. So this industry is getting much more selective about what headcount is actually accretive to to the generation of capital for these businesses. And that can be very difficult for employees. So we've all seen the headlines, the unfortunate headlines about the return of layoffs across startups in the US and beyond. You can see that orange line is employees laid off quarter over quarter. The black line is employees who choose to leave their companies by choice. And you can see in recent quarters, both of them are trending down. So we're not in this severe layoff period that happened in the beginning of the year, but employees have internalized that this is a more difficult place to find a job. And they are leaving their companies a lot less frequently. So there's less need to backfill, which means there's less need to hire, which means there's more molasses and kludge in the startup ecosystem than before. Now, as a founder, what do you do if you can't get a down round, finance on convertibles? You've tried layoffs, you've tried cutting software spend, you're at your wit's end. Unfortunately, a lot of founders are, throwing in the towel at the moment. 229 startups on Carta went bankrupt in Q3 of this year. That's the highest that we've ever seen. Q4 will most likely be worse, and Q1 again in 2024, I unfortunately think will be worse even still. Of course, there are more startups on Carta than there used to be, so we would expect this number to gradually rise, but Q2 to Q3, that's not a gradual rise, that's a peak. And you can see that a lot of founders who began their businesses and maybe even took on some funding are unable to make the switch from zero interest rates, growth at all costs, to high interest rates, growth and profitability, both equally weighted. It's a difficult moment. Now, at Carta, we say that this is one of the more difficult times to grow a business, but it's a fantastic time to start one, and I appreciate all the founders in the audience who are doing just that. So how is this all going to resolve itself in 2024? What are the expectations that we have for new companies being started next year? First and foremost, we expect that the startups started this year and next year are going to be more nimble. They're going to raise more capital with fewer headcounts, and they're going to get to profitability much faster than some of their pandemic peers. And it starts with these early employees. So on this chart, you can see that this is broken out by the hire at a company. So hire 1 is the first non-founder at any one of these startups. In 2022, they were granted about 0.96% of the company. In 2023, that was 1% of the company. And you can see bump ups for each successive hire in most cases. So what's happening here? We see that founders are being more intentional about their earliest employees. They're making sure that they're properly incentivized with upside in the business. And they're probably hiring fewer employees overall, increasing average revenue per headcount and building a more capital efficient business, more nimble cap tables for this next year. The next thing that we expect is that cap tables are going to be a little bit more complex. And that's thanks to the SAFE primarily. Raise your hand in the audience. Who knows what a SAFE is? All of you. Great. Good to hear. The SAFE is a simple agreement for future equity. It was pioneered by Y Combinator and Wilson Sonsini. And essentially what a SAFE is a contract that's a promise. It's a promise that if you raise priced equity, you will give this early believer some equity in your startup. But right now, they're giving you money basically for free. That's not actually true. It's definitely not free. You should read the SAFE documents. But we see this taking over early stage fundraising in the US. And in our APAC startups, we're also seeing a trend towards more and more people raising on SAFEs as opposed to convertible notes. And what we think is happening is that there are new modes of fundraising. The SAFE is one of them, crowdfunding is another, and even more interesting and creative ways to bring your earliest capital into the business that are going to create complex cap tables. They're going to get bigger. You're going to have more angels, more investors, more believers. But we think that this is a great trend for startups because if you can get money in the door and just start building, you spend less time fundraising and more time on your business. Ooh, double. I love it. The next trend in this that we're going to see is more global startups. So Carta offers a product called Carta Total Compensation, where we allow you to benchmark employees not just in the US, but across the world. And you can see that there's a significant trend towards startup founders in the US and elsewhere who would have never considered remote talent. After the pandemic, remote and international tech talent is back on the menu for these startups in a real way. They want to hire internationally, they want to pick the best people no matter where they live, and they want to compensate them fairly. And this is a wonderful trend. It means that talent is not going to go wasted just because you don't end up being born in the States. And it allows startups to be far more flexible about cost structures and building themselves into capital efficient businesses, which is the mandate of the day from VCs. So again, just to wrap up, next year we expect that cap tables will be more nimble with fewer employees per unit of revenue. They're going to be more complex with convertibles and crowdfunding and all these interesting new ways to get money in the door to startups. They're going to be more global. They're going to have international employees and an increasing focus on hiring the best talent, no matter where that talent happens to live. And I think, this is a personal opinion, they're going to be poised for growth. Startups that were founded in 2020 and 2021 have had to deal with the change, again, from zero interest rates to high interest rates, from macroeconomic calm to incredible turmoil across the world. Whereas startups that are birthed today are going to grow up in those difficult times. And it's a truism across Silicon Valley and indeed startups more generally that some of the best companies are founded in the most difficult times. So I'm really cannot wait to see what founders in this audience and elsewhere build over the coming years. And we hope that when you choose to start building, you'll do so with Carta. Thanks so much for your time. I really appreciate it.